so glad that we are having this conversation in this beautiful, with this breeze up here today. We're going to talk about the new kid on the block, direct indexing. Show of hands in the audience, who here uses a direct indexing product with their clients right now, live, already using it? Okay. Anybody looking at solutions right now considering adding it to your practice? A few more. Okay, that jives a little bit with a Vanguard study that you sent me, Gavin, that said that 50% of advisors aren't even aware of direct indexing. Maybe we can start off with each of you, just give us each your own brief definition. What is direct indexing?
You want to start?
Sure, I can start. Thanks for having me, Blair. I think direct indexing is a bit of a misnomer. I know there's been a lot of phrases or catchphrases associated with this type of investment vehicle. I think you have to take a 10,000-foot view. If you think about technology of investment wrappers, you had mutual funds, which were an innovation in their own right 50 years ago. Then you have ETFs, and now you have separate accounts. And there's different benefits and different appropriateness for different vehicles or investment products within each of those. When you think about a separately managed account, it has the benefit of being able to own individual tax lots and be customized. So my definition of a direct index, a custom index, I would just think about it as direct ownership of securities that are professionally managed in some way. They can be customized and they can be tax managed.
Jonathan?
That is exactly right. I would, obviously direct comes from the client's portfolio, their client's account holds directly each of the stocks that would traditionally be in a wrapped product. Index, maybe it's tied to an index. It doesn't always have to be the case. You'll see, I think, a very wide dispersion from, kind of very plain vanilla beta exposure to folks who are trying to do more active strategies, but are also, again, directly owning the stocks. I think what really marks the evolution of this direct indexing, or we call it personalized indexing, is 4 years ago, most of the large custodians went zero commission on trading, and that really opened up a broader audience. We like to say this is the new kid on the block, but in fact, most of these strategies in one form or another have been run by providers for 20 plus years, but just traditionally up in the ultra high net worth space. So it's really a broadening of it out to a broader market.
Yeah, it's almost like the SMA of that's been around for years, reimagined with more capabilities, more abilities to customize based on the client's need. What are, in your mind, the top 2 reasons that an advisor would want to look at using direct indexing for their clients?
It's a super utility play. Like if I'm an advisor, we see, literally work with hundreds of advisors, and I would say, obviously, here in the United States, you guys are going to laugh, you're going to throw bottles at me, but we're blessed with a pretty awesome tax code that lets us choose which lots we want to sell, and it lets you realize losses and hold on to those, turn them into an asset for your client. Not many countries in the world have a tax code that supports that, so it's rare that we would say we have a good tax code, but we do. And I would say 80% of the advisors we work with are starting with that principle as a reason to use the product. So harvesting losses and then using those losses for various purposes in their clients' portfolios or even in their general life, maybe to offset gains from a property sale, et cetera. So that's number 1. Number 2 is customization. And customization you could subcategorize into probably 5 or 6 other categories. So, and I'm sure we'll go through those in this conversation. Gavin, you want to add to that?
Customization, tax management, 100%. I'm in complete agreement. I guess I'd ask a question to everyone in the audience. Show of hands, who has sold a position, a stock or a bond at a loss this year to capture a tax asset for their client? In my opinion, and I'm not an advisor, everyone should be raising their hand. These are assets that you can create for clients in down markets that they can carry forward with them. So when you look at, for example, I focus on the municipal bond asset class. Funny to have a muni bond guy at a tech conference, but muni market's down 10%. If all those bonds are at long-term capital gains rates or loss rates, 10% times 23.8 is 238 basis points of tax alpha that you can create for your client. So you need a manager, you need a process, or you need some sort of way to capture that for clients. And I think for me, I'm very passionate about taxes. That's what SMAs mean to me. It's customization plus tax management. I think there's a lot of focus in our industry on gross of fee pre-tax performance. And I think we all need to focus on the thing that really matters to our clients is what do you walk away with at the end of the day? It's net of fees, after tax, what's the performance of your product? And these types of wrappers are appropriate sometimes to extract those benefits.
Yeah. As we think about that tax alpha that you mentioned, it's almost comical to me that when I started in the business, a couple decades ago, we had SMAs and there was absolutely no consideration for taxes. Like it was almost as if they were running a mutual fund in a separate account, and it was like no thought of what that client is actually going to take home at the end of the day. But that brings up such a good point, and particularly with muni bonds, not only do we have the federal tax code, we have 50 different states, very specific, and then different tax filing status, right? Can you talk a little bit about how you've seen the evolution of SMAs in your work, particularly with fixed income? What are some of the things that advisors may not know that can be done now with direct indexing and fixed income?
Yeah, look, it's a great question. Most advisors that I talk to, even myself before I became more educated in muni bonds, my main background's in taxable fixed income. I learned a lot about taxes as I moved over into munis, is people see munis as a tax-efficient investment just by the nature of buying the securities, right? And the answer is yes, they are tax efficient due to sort of federal and state tax breaks, particularly if you buy bonds in the state that you live in. But above and beyond that, the way you structure and run the portfolio or strategy can create additional tax benefits. And I think that's what a lot of people sleep on. So in a year like this, buying muni bonds can be tax efficient, but it can create additional tax alpha if you actually are thoughtful about what bonds you'd want to sell at losses and how do you efficiently redeploy those proceeds into a similar or higher book yielding security. And I think when we start talking more about direct indexing in equities versus fixed income, I think there's some differences, right? Transaction costs can be really high in fixed income. So turnover in your client's portfolio might be perceived as negative unless you can demonstrate and quantify that there's a reason this bond was sold, we knew how much it cost to sell it, and we were doing that to capture a tax alpha that was much, much larger than that transaction cost. So this is a perfect year. I mean, I can't tell you how many calls we've gotten from advisors. We've been proactively tax managing in our SMAs, but just sort of quantifying the benefits of this to advisors has been huge this year, because even in a down year, you can say, look, market went down, munis are down 10, equities are down 15, but what did you do for me? Was there anything you could do for me to make the situation better? And the answer is yes, there are things you can do. It takes work, but you do need to think about how you want to actively manage those strategies.
Yeah, I call that making lemonade out of lemons. Taking those tax losses and then reinvesting at higher yields now, right? So
I like to call it tax asset creation, not tax loss harvesting.
I like that term. Yeah. And Jonathan, on the equity side, what are first of all, you're the founder of Just Invest, acquired by Vanguard. Tell us a little bit about how you first came to understand direct indexing and what prompted you to found your company.
It's a long story. I'll save you guys. I was at a provider of investment technology, quantitative investment technology, for a number of years. Worked with a lot of institutional investors and their asset managers. Some of the early tax-aware SMA providers were my clients, so I saw what they were doing. And through the work with institutional investors who were bringing in ESG and combining it with their passive investments, I had a realization that every one of you is going to have a different perspective on what kind of ESG, if you even want ESG in your portfolio, and that would put demand for custom SMAs. And we looked at all the providers, and we said, if we bring a lot more technology to this space, if we can mass scale it, it can be a product. And we timed it really lucky. I'm not going to kid you guys. We got lucky with the broker dealers dropping commissions, which opened the floodgates.
Yeah, and you hit the nail on another big topic in direct indexing, which is ESG customization. ESG means something different to every single client. Can you talk about how you're able to take ESG data and apply it in a client's portfolio? Those who have different desires for ESG or different definitions.
Absolutely. So we talked about that there would be a number of flavors of customization that this utility direct indexing can address. And this is probably the most commonly cited one, which is I've got a client, they care about X, Y, Z, right? I have a RA client a bit up the road here. They came to us and they said, hey, our clients just sold a bunch of RS. They had an investment in one of the companies that makes fake meat. They happen to be vegans. I really want to give them a vegan portfolio. Has anybody gone out and looked for a vegan ETF? I'm sure there is one. There must be one, but
there is one.
There's got to be one. But does it have the liquidity that the advisor wants? Is it, what's the bid-ask spread on it, et cetera? So we're able to take, there's a number of very well-known data vendors out there with large institutional quality data sets, combine those, be able to look at every security, what's their involvement in a certain topic, or what's their contribution along certain topics. In the ESG space, you're generally giving your clients two options. You can either say, let's screen out companies that are maybe involved in something that you don't like, or you can lean into something. So if you want companies, if you say do an industry comparison, which ones are showing a reduction in their carbon footprint relative to their peers, you can overweight them and underweight the others. So again, the direct index, and by virtue of owning security level, the client has this ability, or the advisor really has the ability to tailor that to what that client wants, whatever that topic is.
Yeah. You hit on another topic that came up there, which is a founder of a company. In wealth management, we don't always get clients come to us with cash unless there's been a liquidity event. They've already been investing some time. And so it's not always clear as to how you're going to be able to transition a basket of assets that already have embedded capital gains into a direct indexing product. Can you talk about some of the challenges of adopting direct indexing and moving into those products?
Sure. I'll start and let Gavin grab in. But it is a product that is ideally started in cash. You can go out and look at all the studies, and you'll see that in the first couple of years after a cash investment, your tax alpha is going to be astronomical. It's really very surprising. If I cited the numbers up here, you'd probably throw me in handcuffs and pull me off. But it is quite surprising. But then the tax alpha compresses over time. So generally, you'll see studies will talk about like a 5 or 7 year average tax alpha. So if you can start your client from cash, that's ideal. That's optimal for this type of strategy. It's not essential and it's not necessarily, but it is ideal. What we see most commonly, though, is some combination. So as you mentioned, like individuals receiving RSUs from their company, a shelf of them comes due, they decide to sell off maybe half of them, take that cash, ideally at the beginning of the year, so you have a full year of loss harvesting, invest that, and let those loss harvests then unlock, use those losses to sell down further, and kind of create this virtual circle of harvesting and diversifying, selling out of the embedded position and diversifying the position. We call it rinse and repeat, and it is that.
Yeah, I mean, our experience at AB, just to give some insight, we manage $20 billion of SMAs across 19,000 portfolios. I'd say about half of those are generally funded in bonds. Most muni bond investors, they have bonds, and when they transition managers, they give you those bonds to take over management. So, part and parcel of every conversation we have with an advisor is a transition analysis. And in that mind, it's really something that's similar that all direct or custom index providers generally provide now. It's tell me what you would do with the existing securities, tell me how long it would take to do it, and tell me what the tax bill will be. And maybe a tax budget around that and a timeline and things like that. So I think these are really, really good products to move from individual securities or cash into them. I also think something that advisors should consider is thinking about mutual funds that they own or ETFs where you want more customization, you want more tax management. Maybe this year those have losses, right? Maybe over the past year, maybe AGG or your actively managed mutual fund in core space didn't have a loss on it. You pay a huge tax bill to transition it. The world's changed over the past 6 months. So if you have losses or are closer to flat on those types of products, you now have an option to do something different. I'm not saying it's always appropriate to do it, but it's now something that you now have the choice to make and sort of go through that transition process to see if it makes sense for your client.
One of the benefits that we found is that clients also have concentrated positions, right? Maybe they worked for the company, or a lot of people just held on to some of these big winners in recent years, some of the big tech names. Can you talk about the ability to optimize around a concentrated position in a direct index and how that can work together all in one account, hypothetically?
Yeah, I mean, you should expect that your direct indexing provider can provide that kind of service, which is take any investment, whether it's a long-held, low basis, highly embedded, gains position, or even they're just moving from a set of ETFs or mutual funds and they want to transition over time. They don't want to realize gains right out the gate. You got to understand those exposures of what those investments are, and then use the direct index to complete around it. So this notion of a completion portfolio, very well known in the institutional space, very common. You should expect that whatever provider you might choose is going to be able to provide you with that same service. Typically, the provider is going to have some kind of sophisticated risk model that gives them those exposures of the currently held positions, can look at what are the exposures that you want to match into that to complete and diversify, and then make the trades that will carry that transition forward.
Yeah, I think that we're exposing some of the hidden costs of investing that have historically transpired, right? When you move from point A to point B, sometimes there's a big tax bill, and you don't see that in the performance statement at the end of the year, right? It's something that really is hidden and very difficult for the client to discern. I think we're now in a world with more flexible tools, more technology, more optionality in the way you transition assets. I would say run the other way if your direct custom index provider says, we're going to sell the whole portfolio and we're going to generate a big tax bill, right? You want someone who's extremely thoughtful and has a process around minimizing the tax drag or the tax bill when you move the assets. There might be risk reasons, right? Maybe it's just way too big of a position, and that's a conversation you've already had with the client, and you're okay paying the tax bill. But you really want thoughtfulness around it. And I think that's what's beautiful about these separate accounts is there's a lot of flexibility for a manager to provide some value there and help with some of these issues like concentrated positions.
Mm-hmm. It really forces the advisor to do more of a deep dive with their client. You can't just be an investment-only advisor and not understand how the other part of the tax return is working, right? You have to be aware of maybe there's a real estate transaction with a capital gain. I guess what I'm thinking is we've kind of gone from potentially portfolio, advisor as portfolio manager picking individual stocks, mutual funds, the ETF revolution, maybe some SMAs were used in certain points, and now we're almost removing the wrapper, as you will, of the ETFs and the mutual funds and buying, the individual securities again, but it's not the PM, the advisor as PM. It's using, basically, is really all of this happening because we have the technology now? I guess that's the question I have for you guys.
I would say fundamentally yes. I mean, two things. One is we've thankfully moved largely away from stock picking. I think we all have come to accept that whilst there may be a few individuals out there with superior skill and knowledge, the rest of us don't. I certainly don't, and I think most of us would accept we do not have the skill to pick winners on a consistent basis. So we're not back to stock picking. We are back to a systematic rules-based process of making investment decisions. That is very clear, it's very transparent, it's known to the advisor, it's easy to communicate to the end investor. So that's first piece of it. It's all enabled by technology. I'm sure for fixed income as well, but we couldn't do what we do until the cloud came along. The amount of computing power that we throw at all of our client portfolios every morning and throughout the day to be able to run them through risk analysis, to run them through multiple scenarios, and to run them through algorithms that determine whether it's optimal to trade them, whether it's optimal to loss harvest, or whether there's some kind of ESG data violation. All of these things take an enormous amount of compute power to do on mass scale. So technology has been a critical enabler of it.
Mm-hmm.
Technology, huge, and it's really transformed the way that we've invested fixed income portfolios. A perfect example is everything that I'm talking about we've developed over the past few years, and we've invested a lot of capital in it. Day one, when we were working with a team of quants and data scientists, there's 1 million QSIPs outstanding in the muni market. So we wanted to create an optimization engine to layer custom indexing on top of the muni market. It took 3 days to get a result. So you can't run these huge numbers in math problems without thinking, being really thoughtful about how technology can help you solve those challenges. So what we do now is, there's thousands of bonds that are pre-selected and screened based on attributes that the client's looking for, based on pricing data, liquidity data, internal research, quant and fundamental, and then we run optimizations on those. And I think this concept of optimization, right? Tracking error minimization maybe in an equity sleeve, maybe in a fixed income sleeve, it's maybe more total return focused, maybe less concerned about the benchmarks, and maybe tax management where you live, state sort of muni, considerations. But it's all technology related because, when I sit down every morning in the office, I don't run through all 19,000 portfolios myself. We have tools and processes that lift portfolios to the top, that get optimized. There's a whole bunch of new technology that really helps us scale this whole customization problem out, which is really exciting. I'm excited to see how much further we can take it.
Yeah. And again, indexing might really be a misnomer here because we're not talking about, just give me the S&P or the Russell 3000, although those products do exist. It's really about down to the level of how the advisor wants to display their investment philosophy, right? We want to have an allocation to U.S. versus international growth value, maybe some other factor type investing. Can you talk about how this is a way to really take what advisors have been doing for the better part of the last 2 decades, which is come up with an asset allocation and then plug in mutual funds and ETFs. Now, really, you're giving the advisor the capability to build their own models in a direct index. Is that right?
Absolutely right. I would say it varies a fair amount from advisor to advisor, but you could run the gamut. We see lots of advisors who are just looking for some component of beta exposure, whether that's U.S. large cap, whether that's all cap U.S., whether that's international dev ex-U.S. As you go outside of the United States, you need to be aware, particularly on the major custodians, that there's ADRs, and they have some liquidity issues as you go down market cap, and then if you want to trade foreign ordinaries, it can be cost prohibitive. So you thus limited your universe. So there are certain considerations you want to be very careful about and thoughtful about with your clients when you try to go ex-US. Then you could also think about, smart beta or factors, however you may think about it. And we see lots of shops that don't. That's not their thing. They don't do factor exposures or factor tilting, but we see a lot of advisors who do. And so, I want growth with quality, or I want tilt away from large cap and into small, some of the traditional FAMA French type strategies. Very easy to implement those into a direct index, provided that your partner is giving you the tools to be able to both see those exposures, implement those exposures, and track them over time.
I think the willingness as an industry to have these tools available to advisors has shifted dramatically in the past few years. I remember a few years ago having conversations at wirehouses. It was around product approval. Like, it either looks like a mutual fund, it looks like an ETF. What is this thing, a custom SMA? How do I wrap my arms around the risk of approving this for advisors if they can pull all these different levers? And you look at all of our lives, right? Everything is more personalized and customized now. And I think the world is now coming around, right? Both at wirehouses and at independents, right? It's now we're embracing that. And there still might need to be risk controls in place that you can't do anything in any single strategy. But I think that there's a lot more flexibility, sort of being provided to advisors. I know personally, we've had a very large wirehouse approach us and said, we love one of your actively managed muni bond SMAs. We want you to do that with 15 different customization levers. And that was the same wirehouse that 3 years ago said, you can only offer one product and that's it. So I think the world is changing, so it's good.
Yeah, that's interesting to see. I mean, it used to be on a fixed income SMA, you could, maybe play a little bit with duration. You could have the short, the intermediate. You might have some credit quality constraints, state specific in the bigger states. But now the ability to really get down, and you said 15 levers in an SMA strategy that's customized. That's a pretty amazing shift, and to see those, the gatekeepers, if you will, allow that in is a pretty interesting change.
Yeah, I mean, clients are all different. I mean, one of the products we've sold a lot of has 45% of it's in high yield muni bonds, and some advisors say that's too much, right? So now we're able to say, well, if you want a little bit less, we're going to have a lever that you can move it down to 20, you can move it down to 10, you can move it down to 0, and we'll go full high grade. So it's the same product, it's the same process, the team, the technology, but it provides a lot more flexibility now to customize that solution. Sector restrictions, like I don't ever want to buy a tobacco muni bond, right? Things like that are now allowed. That before, I think it was the mentality, but also the technology and the infrastructure of how do I not overwhelm an advisor with a million different options. So I think we're investing in a website where you can go to a custom design center and say, here are the things that I want it to look like. I'll have a digital record of their tax information, their customizations. I can log in there from time to time and check on what that account is doing. So I think those sorts of layers on top of these products are really unique, right? You don't get that with a mutual fund or an ETF. You don't have a UI. I think having a UI with investment products is something that's bespoke to SMAs and something that's powerful in allowing the advisor to control the customization, understand it.
Yeah, that's interesting. Jonathan, you mentioned the tax alpha depletes over time. Can you just help us visualize why that is, right? So, let's say you start out with cash and you have a big down year, right? And so you're going to be selling securities, booking those tax losses, potentially buying them back after the wash sale rule, but maybe going into others. And then eventually, right, you're going to get a bull market. So does the tax loss benefit go away completely, or how do you, we're kind of new into these products. What do you think this is going to look like 10 years in when a client's been in a direct index?
Yeah, so there's lots of data out there. Obviously, a number of providers have been in this space and have been managing, as I said, ultra high net worth and high net worth. Even in our short history of 6 years, we've got, extensive data sets now looking at the time, what I kind of call the time decay of tax alpha in accounts. And it's an important thing. It's, you don't want to, as an advisor, I think it's really important that you're upfront with your clients about all aspects of a product. So what I would say is, our observation, and I think, again, that the industry data supports this, is that you're typically looking, if you do nothing, if you simply invest from cash and do nothing and let the direct index provider loss harvest, you're looking at a 7 to 10 year duration on that portfolio before it becomes largely at gains. And why is that? Generally, over a 10-year period, you're going to see pretty significant equity market increases. Yes, you'll have some down years, but over a 10-year span, you're going to have a generally uptrending market period. So that's going to, just think of the process, right? If you're harvesting a loss, right, you're not avoiding the tax loss, the taxation of that, you're really just deferring it. So you're capturing that loss, you're buying another security. Eventually, all of these securities are going to increase in value. They're going to get over to a point where you probably, unless you have a major decline of like 50%, some kind of drawdown on that magnitude, you're probably not going to be able to sell out of them without a gain. Okay? That's okay, because we've lost harvested along the way. We've gotten benefit from that. But there's also a number of things you as an advisor and the client can do to continue to keep that account healthy and to extend its longevity. Obvious one is let dividends reinvest. So every time dividends happen, or cash mergers. Some clients like to sweep those out and use that as part of their income stream. But if you can find that they can get an income stream from a different part of their portfolio and let the dividends reinvest, that creates fresh lots for tax loss harvesting. And then even more ideal, if that client's still in their accumulation phase, if they're still working and maybe they're getting a cash bonus every year, and they can put 10 or 15% of that into the account, then that can also continue to keep the account quite healthy. So there are ways to extend the life of these accounts. And then ultimately, again, you're an advisor, you've got a great opportunity when they do get to that phase to have talks with the client about what to do with them. Are they charitably minded? Well, that's a great asset to start giving away rather than cash or other parts of the portfolio. They can move them into trust, take them out of their tax ID and transfer them to another. Maybe they put them into a CRAT, generation skipping trust. So there's lots of opportunities that it still creates for you as an advisor to engage that client in very meaningful management of their wealth.
One add-on to that, and I'm not bashing equity direct indexing. I think it's fantastic, and we should all be doing it. But what's interesting and surprising to me that more people aren't thinking about this in the fixed income sense is everything Jonathan just said is different in the bond world. Bonds pay coupons and bonds mature, which creates natural opportunities for that portfolio to automatically reset its cost basis. So the longevity, if you think about a liquidation value of an equity DI product, maybe 7 to 10 years, which is still a great value that you can provide, I think you can do it over more sustainable, longer periods of times within the same SMA for fixed income, just because you're throwing off coupon income. Bonds are ephemeral, they mature, and that provides natural pull-to-par opportunities where you're going to reinvest that cash, reset your cost basis, and create forward-looking opportunities to tax manage those tax lots.
I like that.
Yeah.
I wrote a white paper on that if you want to read it. It's on alliancebernstein.com.
I do want to read that.
I would
I'll
like
send
to
it to
read
you.
that as well. That's fascinating. So we all know that when we look at a mutual fund performance track record or even an SMA composite, that that's not the real take-home return of the client, right? They didn't necessarily have all their money invested on January 1, and for a host of other reasons, fees may be different, taxes, of course. How can we start to report, or how can we convey to clients as an industry the benefits that they're getting, from the tax alpha, from the customization? Are there any ways of sharing performance that can be more detailed and specific for clients?
Absolutely. So, again, as you go out and look at providers of these services, I think you should demand that they provide you with pre-tax, your traditional time-weighted return on that. And that's really important because you want your client to know how they perform relative to a standard index and if they had been invested in, say, an ETF to that index. So it's really an important reference point. It's what they're going to see on the news every night. They're going to have a mental measurement to that. But as you're saying, Blair, you also want to be able to communicate to them, what's the benefit? Are we actually achieving that benefit of moving you into a direct index? Are we getting particularly the tax benefit? There is a fairly standard method out in the industry. I know at least 4 providers all use the same methodology of running a shadow benchmark. As you loss harvest, you make an assumption that the client has gains to offset, and then you take their tax rate and you apply that to what we call a tax shield and add it into the return of their account. This is hypothetical, so it's not realized. It does assume that they're going to have use for those losses. And then also any kind of taxation is going to happen in the benchmark as well. Several white papers are out there. You can look this up. If you just Google tax alpha performance, you'll find great papers on how to do it. So all the major vendors do this. You should expect it, and it should be daily. And just like if you were to go off to Black Diamond or Tamarack and have your general accounts getting performance on a daily basis, you should expect that your tax direct indexes are also reported on a daily basis.
Yeah, after-tax performance is key, 100%. I think one thing that we're focused on doing this year is sometime early in January, we want to send all of our clients tax scorecards, right? So we want to go through every trade that we did in the portfolio that year, whether it generated a gain or a loss, multiply that by their tax rate, and go through some sort of tax benefit or net tax benefit. I think that's a really, really nice thing that you could show to a client, potentially, to say, look, here's what happened this year, here's why we had this type of exposure in the portfolio, and here's something that it did that was good for you, that turned lemons into lemonade. So I think that's something that I would definitely look for different providers, is after-tax returns and some quantification of tax benefit.
Mm-hmm. Yeah. I just want to remind you guys that you can ask questions of the panel on the Slido app. So we've got a couple here. Maybe we'll just throw some of these out. Can you guys touch on the pros and cons of outsourcing direct indexing versus an advisor managing their strategy in-house?
Okay, so I'll give you some situations for you to consider and let you be the judge of whether you'd want to do it in-house or outsourced. Let's go back to February 23rd, 2020. Ominous days, and we went through a pretty quick market decline from February 23rd to, I think the bottom was March 26th, something on the order of 30%, and very volatile and a lot of news. If you choose to do it in-house, you've got to be prepared to manage those accounts. That's sort of the interesting thing is these time periods, which I'll call volatility clusters, they're kind of unique. They're clear artifacts in the market, and they're typically short-lived. They're also prime time for direct indexing tax loss harvesting. So when the market's declining like that, yes, it's highly unsettling for your client. It's probably highly unsettling for you, and you're thinking about even your own revenue in your business. But it's also the time that you've got to be laser-focused on that account, managing it, loss harvesting it, managing the wash sales. So that's a challenge. But if you've got a team that does that, and they're sort of isolated, and that's their function, that might be perfect for your firm. You have to kind of decide, do you want to be trading or managing clients, and do you have the bandwidth to do that? That's one piece. The second piece is, we're up here telling you that it's easy. It's easy for us because we've invested massive amount of energy and money and into the technology to operate it. That is an expense that has to be borne somewhere. And so the tools that we're going to be using to run this for your accounts is highly sophisticated. It's come out of years and years of quantitative finance. And yes, there are providers out there who are going to lease it to you or rent it to you, but it's be a cost to your business. So you've got to understand what is that trade-off between what does it cost to your business, what's the benefit. And again, I can't make that judgment for a business. It's really kind of unique to each company.
Yeah.
Yeah, look, that was really well answered. I think, when you're picking a provider, you need someone that can trade internally. So that's the difference with fixed income as well. That the trading apparatus is part of what you're outsourcing. So I would think about it in the bond space. You're outsourcing the portfolio management and research function, and you're outsourcing the trading function. When you look at AB, we manage $60 billion of muni bonds. We manage $300 billion of fixed income. We have relationships with dealers. So the levels that you can get on these bonds, and I've seen this, when you look at the advisor space and you look at the institutional space, it's 1 to 2 points of bid offer that you're giving up when you buy bonds in that space. So that could be hundreds of basis points of return. And when you think about these products, I'm talking my own book, but the management fees aren't egregious on a lot of these products. They're fairly inexpensive. So when you think about what you're getting, if you're getting portfolio management and research and you're getting best execution, and on top of that, the tax alpha is delivering massive amounts of value in particular years, these things pay for themselves, over many times.
Yeah. That leads to another question we should probably answer here. Like, what are we talking about as far as account size, account minimums? I mean, this really is more of a high net worth type product, right? And can you speak to some of the costs that are associated?
So I'll challenge you there, Blair. One of the reasons I got into this business was I don't believe it's a high net worth product. It is absolutely a great product for people with wealth, no doubt about it, and that's why it started there. But again, because commissions of basically equity space, commissions have largely gone to zero, and we're seeing fractional shares are right there at the edge. You guys know as advisors, you're probably not getting fractional shares yet from the brokers associated with the custodians, but it's right there. They're making it available to the retail clients. It is soon to be available. And that opens up the benefit of these strategies to much smaller account minimums. Today, typical minimums going to be $200,000, $250,000 to start, and that's mainly been driven by, again, I'm speaking equity space only. If you think about trying to track U.S. large cap, until recently with the recent splits, you had large, high percentage weights in the indexes that were also trading in the thousands of dollars, $2,000, $3,000. So if you couldn't do fractional and you had to buy Apple and you had to buy Amazon, you had to buy Tesla, you very quickly just ran out of capital to get a diversified portfolio and have reasonable tracking error. So that has been the impediment, and why when you look across the industry, most providers are in that 250 minimum space. Once fractional shares become standard issue, I think then you can really expect that 50,000. Then you start to think about sizing the account so that it's optimally harvesting the loss amount that's best for that client. And remember, you can even offset this in your ordinary income when you file every year. So it's useful even for us. I argue, if you think about utility curves, yeah, high utility for high wealth people. So this is ultra high wealth out here, and this is the rest of us down here, closer to the y-axis. Got lots of private investments. I've got a lot of hedge funds over here. I've got lots of capital gains. So great, I've got all these gains and I can offset them. That's why it's always been a product that was favored by high net worth folks. But if you follow that utility curve, the people down here at the other end, if they can save $3,000 a year in tax, that's real money in their pockets. And I would argue it actually has higher utility than for the mass affluent in the middle. So I think it's a product that every advisor should be thinking about once it's easy to access, and once it can be sized down, should be a consideration for every client.
Yeah. Do you think we'll ever get fractional bonds?
I'm working on it.
Yes.
I had some discussions with the SEC. There's a lot of custodial issues to work out, so I think that we're a couple years out from even going down that path, but I think it's possible.
Yeah.
We need to get creative with it.
Yeah, it's even harder. The minimums are usually even larger sometimes for bond SMAs.
Yeah, so our minimums are 250 with a new custom product that we released this year. They're now 125 for that product. My philosophy is the same as yours. I want to make this as broadly accessible to retail investors as possible. So bringing down minimums is important. There's only so far you can do that without sacrificing the structure and the diversification benefits of the portfolio. Muni bonds trade in $5,000 minimum piece sizes. So if you think about a $125,000 portfolio, if you're focusing on the high-grade muni market, there's not a lot of benefit to diversifying across CUSIPs, so you can buy 20, 25 bonds and get a portfolio funded at $125,000.
Fascinating. I look forward to that. I think we're running out of time. Direct indexing may be a misnomer. Do you have any suggestions for maybe what we should start calling it next?
I gave up on that argument a long time ago. At Vanguard, we call it personalized indexing because we want you to personalize it to each of your clients' situations. But whatever it's called, it's a good product. It's got a lot of utility for you and your clients.
I think it's like when ETFs first came out, they were all passive, so people sort of thought ETF and passive were synonymous, and then Cathie Wood came around and everyone's like, ETF's a great wrapper. You can do a lot of active investing in it. So I think it's the same thing here. Custom SMAs is a word that I would think about it, or direct ownership with professional management. But I do think that there's a lot of active elements to these products that provide a lot of benefits, and it's going to be interesting to see how that evolves.
Yeah. Well, Jonathan, Gavin, thank you so much for being here to talk about this. It's been a great conversation about direct indexing.
Yeah, thank you very much. I would
Thank you.
just say to all of you, and Gavin, you're welcome, but right behind you is the Vanguard booth. We're going to be hosting drinks there, and if you didn't get your question or this sparked some questions for you, come chat with us. We're here to help you get educated on this and find the best use for your clients.
And the AB booth
And they have a
doesn't have
roof.
much, but it has koozies and pens. So if you want those, come on by.
Thanks, guys.